L nerd. What was going on with this credit union Experian or Equifax?
Yeah, it's Equifax. So dude, this was nuts. So I was telling you a little bit about this offline, but they fucking gave the wrong credit score out to millions of people looking to buy homes, cars, or deal with credit card loans. And Equifax is like fucked up in the past. We all know that they had that big hack that they suffered years ago, and it's just now we're getting to the point where it's like, are we going to continue to trust these like private credit bureaus? So there's three of them. A lot of people don't know this if you're not, privy to credit cards or whatever. So there's Equifax, there's TransUnion, and then there's Experian. And basically the way it works is like these three companies, they like have their own proprietary algorithms that like essentially assign you a credit score. And the credit score is then used for, getting a mortgage, like to run your credit, or getting a car or whatever. Anything that you're buying where you don't have the full amount in cash, you would need to have a credit report ran. Even in the event of like getting an apartment, right? Because like if I'm a landlord or you're a landlord, like you want to make sure that the guy that you're going to rent to is good for the money, and like he's got a good track record of paying off debt or paying off any sort of like accrued liabilities over any fixed period of time. So that's the whole point of these credit bureaus, is to like kind of assign everyone a credit score, and that determines how credit worthy you are. But the biggest problem is that they all suffer these fucking hacks all the time, or data leaks. And now in this case, it's like I just said, Equifax giving people the wrong credit scores. So now I can imagine, right, how many people are affected. Well, we just established that they gave millions of people who are looking to buy homes, get cars, take on other different types of credit. They gave out the wrong scores. So is it the wrong scores where it's negatively penalizing people, which would mean that lending actually is better off? Or is it like a guy has a 640 credit score and you have him down at 800 and now he's able to buy a house that he really can't afford, And it's like, where do we, like, is it that they had these scores that they made so far underreported, which actually, like I said, would be a good thing, because even if the guy could afford to get, if his score is going to be used and it's going to be used to help him get a house, if his score is reported as less, that means that the terms of the mortgage aren't necessarily favorable for him, but that he'll actually, won't qualify for a house that's like at like that fair rate based on his credit score. But then the other side of it is, what if it's, like I said, a guy with a 640 who has like an 800 score, like a fucking an 810 score. Now he's able to get some baller house, even though he's not obviously good for it because he's got a shit credit score. So it's going to be interesting to see. But my main question to you is, like, at what point do we kind of just get rid of these private credit bureaus, because they've been having nothing but problems with data leaks and managing information, and even just assigning these credit scores. They keep changing the fucking criteria too. They had the FICO 8 scoring model for the longest time. Now I think they've moved away from that, and I don't know. I've heard, at least with the FICO 8, when they used that, I actually I found someone who cracked the algorithm, and it was very interesting. People like reverse engineered it and figured out how to get like a perfect score. And it's very interesting. I'll just leave it at that. But at what point do we get rid of these credit bureaus is pretty much my question to you.
Yeah, that's a very interesting question. I was watching this interview with this guy, Adam Bastamonte. I don't know if you know who he is. He's basically, they say he's this former CIA agent, and he basically gave his synopsis or whatever. What he was talking about was that all data basically is susceptible to being hacked, or is it's out there when all your data is basically not protected. And he was an advocate of after 9/11, when they came out with the Patriot Act. He basically argued for the Patriot Act, and he basically explained to people how once you sign up for something, or once you go online, your data's on the computer, you should knowingly know that your data is out there. So I think your credit data is obviously it's going to get exposed. It's going to be hacked, just like every other part of your data. but these private companies, they do have a responsibility to try and protect your data. But I think it's kind of like a lost cause. I don't think they ever going to be able to truly protect the data in that regard. But credit scores are, they use for like a lot of weird things. I know we were talking about car insurance earlier. You know that car insurance companies, they some of them, they use your credit score to tell you your rate. You might not think like, oh, what does your credit score have to do with your insurance rate? But they say that people with lower credit scores are actually more dangerous drivers. I don't know how they came to that conclusion, but they did like studies and such where people with low credit scores are actually more dangerous drivers, get into more accidents and have more claims than those with higher credit scores. I guess it has to do with like some sort of like you have discipline in one regard, then you might have discipline in another regard. But
That makes
yeah,
sense. Yeah, that makes sense. They have a lot of those actuarial science guys looking at shit like that and looking at data and trying to draw the parallels. So I'm sure that there's some validity to that. If you have a shittier credit score, you're like a bad driver. I think that's definitely true. There's also in finance, like for anyone that goes to work in finance, there's also something called like the Fair Credit Reporting Act, where like if you go to work in any job in finance, buy side, sell side, you go to work at any type of like large institution that manages like over $1 trillion. The Fair Credit Reporting Act, you have to like disclose. They run your credit and they want to see if you're like delinquent with your credit. And the whole rationale is like if you can't afford to pay your debts, if you have any, then why would they hire you? You're more at risk of like stealing money from clients or like doing something shady within the company and like pilfering money because you have like if you have like $200,000 or $300,000 in debt or whatever, and then you go to work at like a finance company, that's they know that you're like desperate to pay that off, and if the salary they're going to pay you isn't obviously enough to pay that off, they might not hire you because of that. They kind of could see you as like a red flag or like a threat to potentially break laws and to steal money from clients or whatever the case may be, or from the company itself.
yeah, that makes perfect sense. I know some states like you're not allowed to use credit scores when it comes to like insurance and hiring and such. Like like I know like California, Hawaii, Oregon, and a few others. Like you're not allowed to use it, but like some states that actually allow you to use credit scores for like other things besides financial matters and applying for credit and such. So like your credit score actually has a larger impact than you think. It's not only like what mortgage you qualify for or what credit cards you can open. It has there's some things where you might think, oh, your credit score doesn't matter or it doesn't apply to this, but like these actuaries are actually applying your credit scores to things that at face value might not seem the same.